Is Rivian a buy at 11.50 per share? And if you want to build indestructible generational wealth, is Rivian a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis on Rivian based on their recently reported 2024 results. I think Rivian is a great tactical investment, and at 11.50 per share, I have a buy rating on the stock. In my research, I discovered 6 things that got me very excited and 4 red flags to watch out for with Rivian. So what did I discover? What is my value for Rivian stock? And what's an ideal entry point should you decide to become a Rivian shareholder? Let's dive in and find out. In this video, I will cover Rivian's recent results and what everyone is missing, what I think about Rivian stock and what my analysis uncovered, what Wall Street's smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. Are you an investor in Rivian stock? Why or why not? Let me know in the comments below. Rivian released 2024 results that beat estimates, and they achieved their first quarterly gross profit. If you're enjoying this, please smash that like button. Let's cover the red flags first. Many cite the removal of the $7,500 EV tax credit as reason for being bearish on Rivian. Due to the price of Rivian vehicles, they were only eligible for half or a $3,750 tax credit. Rivian vehicles range from a $75,000 to $105,000 price tag, and the tax credit is for vehicles $80,000 and below. There is a loophole where leasing companies can apply for the tax credit and pass it on to customers. Rivian hit a 52-week high of 1886 in early July of 2024, and it is down over 40% since then. The 52-week low of 826 was in April of 2024, and it's up almost 36% since then. The reason this does not bother me is that there are 2 investors who own over 276 million shares. They've been in since the beginning and have not sold 1 share. Stay tuned, and I'll cover who these true believers are very soon.
He's an investor.
Since the company's IPO in late 2021, shares outstanding have increased 100 million. This is mainly due to the use of stock-based compensation, which is paying employees in shares rather than cash. The good news is that this has been decreasing over time, down 17% in 2023 and 16% in 2024. Many of those who are bearish on Rivian cite the cash burn rate, which is the amount of cash the company uses rather than generates. Average quarterly cash burn has improved over the last 2 years, and it showed significant improvement in 2024. I did an analysis of cash burn to see if it's a genuine concern. As of 12/31, Rivian has over $9 billion in liquidity. If we look at average quarterly cash burn in 2024, this gives them 3.5 years. But if we look at the average over the last 3 quarters, it gives Rivian close to 10 years of runway. Here's what got me really excited. In a survey on owner satisfaction conducted by Consumer Reports, Rivian earned the highest score for the 2nd year in a row. 86% of Rivian owners said that they would buy a Rivian vehicle again, and it was the only company with a 5 out of 5 satisfaction score. The Insurance Institute for Highway Safety listed the R1S SUV and the R1T pickup as its top safety picks.
Hey, that's a great company.
Rivian achieved positive gross profit for the first time ever in 4Q 2024. Operating expenses declined by 15% year over year. They removed $31,000 of cost per vehicle compared to 4Q 23. And on January 16th, Rivian entered into a $6.6 billion loan arrangement with the Department of Energy to support the build out of their Georgia plant. This will create 7,500 jobs, enable initial production capacity of 215,000 units, and the potential capacity for 400,000 units. Through its relationship with Amazon, Rivian vehicles have delivered over 1 billion packages. Amazon now has over 20,000 electric delivery vans on the road, with 80,000 more scheduled as part of their agreement. Also, Rivian ended its exclusivity with Amazon in November of 2023, with AT&T ordering vehicles from Rivian in 2024. This provides a nice revenue stream for Rivian, as commercial orders tend to be very sticky and long-term. The Rivian-Volkswagen joint venture has supplied Rivian with $2.3 billion of capital, and another $3.5 billion is expected over the next several years. Through 2028, Volkswagen will fund 75% of the shared platform costs. Amazon and Saudi family office Global Oryx are true believers, and they've been with Rivian since the IPO. They own 276 million shares and close to 25% of the company, and they have not sold a single share. New investors include Bally Gifford, a UK asset management firm, which has bought over 50 million shares in November of 2024, a 4.4% stake, and Volkswagen, who owns a combined 95 million shares purchased in October 2024 and February 2025, an 8.5% stake. This is what everyone is missing. While only 9.7% of revenues currently, software and services has grown rapidly. The segment grew 190% in 2023 and 60% in 2024 and provides a recurring revenue stream for Rivian. This segment includes things like vehicle repairs and maintenance using AI-powered diagnostics, subscription-based services such as Google Cast, YouTube, and real-time security feeds, and autonomy subscriptions, a future paid hands-free driving feature which will drive long-term revenue. When it comes to any stock, I let the numbers tell the story, and that involves looking at a company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
I don't think that's a good idea.
That is exactly what you're doing when you buy a stock without understanding the three financial statements. If you want to value companies like the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Rivian has some very unique features in its debt, and I can't wait to show you. Rivian has $7.7 billion of cash and short-term investments. This is what makes up the bulk of their more than $9 billion of liquidity, which we covered earlier in the cash burn analysis. And the company has been net cash in their entire existence as a publicly traded company, which creates tremendous flexibility. Retained earnings is negative, but this is to be expected with an early-stage growth company, and this should improve as the company becomes more profitable in the future. While the company has $4.4 billion of debt, it is a very unique structure. $3.2 billion of the debt consists of convertible notes, and these notes have a PIK or paid in kind, not cash interest feature. This interest adds to the balance. It is not a cash outflow, which gives the company more financial flexibility. So what's the takeaway? Rivian is an early stage growth business with a conservative balance sheet and a promising future. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Revenue has grown over 90x from 2021 to 2024. The 80,000 vehicles that still need to be produced for Amazon, the new orders from AT&T, and the Volkswagen partnership will provide continued high double-digit growth. Gross profit is negative, but it was positive in 4Q24. The company has done a phenomenal job cutting costs, and gross profit is projected to be positive moving forward. I was very conservative with my estimates, which is why we don't see positive EBITDA or net income in the projections. Interest income has been greater than interest expense for the last 3 years. This is because the company has been net cash, meaning cash is greater than debt, so the interest generated from invested cash is able to cover the interest expense and leave some money left over. So what's the takeaway? While we do not see positive EBITDA or net income, for an early stage growth company, they are showing improvement, which is a very positive sign. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, financing, which is the cash the company generates externally. When we add these 3 together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. While free cash flow is negative, we see the same improvement since 2022 that we saw with gross profit. Rivian actually achieved positive free cash flow in 4Q24 of $856 million. CapEx has been very reasonable despite being a car manufacturer. Since the IPO in 2021 through 2024, the company has very conservatively managed its capital expenditures, which has boosted the improvement of free cash flow. Rivian has taken a page out of the Mag 7 playbook. It has generated over $4.5 billion of cash from short-term investments. So what's the takeaway? While we aren't surprised by the negative cash flows of an early-stage growth company like Rivian, improving financial results since 2022, a newly announced partnership with Volkswagen, and increasing production and demand all mean a brighter future for the company. So what does this all mean for the valuation of Rivian stock? Let's cover that next.
Show it to me.
On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value of the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to value companies like we do on Wall Street so that you can build generational wealth, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments, we get an intrinsic equity value about $17.6 billion. We divide by the current shares outstanding, we get an implied share price of $15.56 compared to the current share price of $11.20. That's a 38.9% discount, which is a buy rating. On Wall Street, if a stock is trading at greater than 20% discount, it is considered a buy because it provides us a margin of safety. So what does Wall Street have to say about Rivian stock, and how can that impact your portfolio? Let's cover that next.
Let's hear it.
Analysts are cautiously optimistic on Rivian, influenced by factors such as delivery forecast policy changes and market competition. Mizuho has a neutral rating on the stock. They lowered their target from $13 to $11. Mizuho adjusted the rating to neutral, reflecting concerns over a softer demand environment and potential policy changes affecting EV incentives. Guggenheim has a buy rating on the stock. They lowered their target from 18 to 16, and they remain positive on Rivian's long-term potential, but acknowledge near-term challenges, including increased competition and policy uncertainties impacting EV demand. Benchmark has a buy rating on the stock with a target of 18. Benchmark maintains a bullish stance due to Rivian's strategic plans, including the upcoming R2 platform launch, anticipating a robust delivery ramp-up in the latter half of 2025. This is a screenshot of CapIQ. I use it all the time for my analyses. 28 analysts cover Rivian on Wall Street. The target price range is from a low of $6.10, which is a 46% decrease from the current price, to a high of $23, which is a 105% increase from the current price. Upside outweighs downside by almost 2.3x, 105 to 46. Hedge funds typically look for 2 times and above. The median is 1410, which is a 26% increase from the current price. The overall rating on a scale of 1 to 5 is 2.52, which is a hold rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do own a position in Rivian. I am a believer in the company, and it is currently the 7th largest position in my portfolio with a weight of 7.5%. Now, if you decide to buy Rivian, I'll tell you exactly how to build a position, which I'll reveal shortly. As mentioned earlier, 86% of Rivian owners said that they would buy a Rivian vehicle again, and it was the only company with a 5 out of 5 satisfaction score. Edmunds rated the R1T as the top-rated electric truck in 2025. They even stated that the R1T stands head and shoulders above every other electric pickup on sale right now. Cash burn has reduced significantly, free cash flow was positive in 4Q24, and most importantly, the company achieved positive gross profit in 4Q24. The Amazon partnership has opened up commercial vehicles for other companies, and this will be stable and growing revenue stream long-term. The Volkswagen partnership is just beginning and will provide a major growth engine for Rivian. The second generation R2 launch includes the Tri-Motor, which goes 0 to 60 in 2.9 seconds, and it will be revolutionary for the company. Rivian hit a 52-week high of 1886 in early July of 2024, and it's down over 40% since then. The 52-week low of 826 was in April of 2024, and it is up almost 36% since then. If you see the longer-term overall strategy and the uniqueness of commercial delivery vehicles and high-performance trucks, then Rivian might find a place in your portfolio. Rivian is a satellite or tactical position in my portfolio. As it becomes more profitable, its intrinsic value and market share will continue to grow. My model shows a value of $15.56, which is a 39% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Rivian is a buy at current levels, and if you decide to add it to your portfolio, this is what you should do. First, decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position. If you like this and want to see another in-depth stock valuation, check out my Celsius video here or my Tesla video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.